All right. Let's check this out. I got some new equipment here. Trying to get over that big failure of hardware and software that I had the other day. And so I am looking forward to trying some of this new equipment. I got this new headset, very expensive, not like my old headset, which was very cheap. So I got a new one. It's nice. I can hear myself in the ear, everything works really good. Hopefully, it sounds good to you guys. Bruce, I see you out there saying hello. You want to give me a sound check with my new equipment? and we'll get rocking and rolling here. Market's getting ready to open in a couple of minutes. And I want to talk about the progressive trading. Oh, losing my voice already. Look at that. Get my tea. Sounds good? All right. Good. This may be a short class today. I got no voice. All right. I want to talk about progressive trend lines today. That's what we're going to do. All right. So, progressive trend lines. What are progressive trend lines? That's what we're going to learn today. I'm going to show you some really cool stuff. All right. Some really neat tools that can help you with your trend lines. And that's what we do in this class, right? I mean, that's what we do when we trade. We trade trend lines. You always hear me say trend lines are the most powerful tool that we have. In my opinion, single most powerful tool we have is just the simple trend line. And so we want to learn a little bit more. I just want to kind of go back to the basics and talk about trend lines. And that's what we're going to do today. And we're going to try and do a little options trading. My voice will stick with me. And we're going to use trend lines to trade some options. How's that sound? Sound fun? But before we do that, we always have to go over and see what the Goolsbys are doing. All right, let's go see what the Goolsbys are doing. The Goolsby family over here in the Fed. So the Fed, Kashkari, Goolsby's not speaking today. Mr. Kashkari is speaking at 7 o'clock. So he already spoke 30 minutes ago. Mr. Fed Waller, he speaks at 1 o'clock today in the afternoon, and then Fed Kashkari, he comes back and speaks again. He's a very important man. He gets to speak twice in one day, at 7 a.m. and again at 3 p.m. So that is the only Impact 2 news. There is no Impact 3 news on Monday. That means that it's going to be a really quiet day, probably. Let's look at Impact 1. Look, there's not even any Impact 1s. Oh, my goodness. Today is going to be a really quiet day. What about tomorrow? Same thing, 6:30. New York Empire State Manufacturing, Red Book Consumer Inflation. That's at 9 a.m. That'll be interesting to see what happens tomorrow. Fed Daily, he's another Fed. 3-month T-bill, 6-month NOPA Crush report, Fed Kugler, and Fed Bostic. Again, Impact 2. Don't know if they'll say much that'll make anything move. But man, this is going to be a quiet week on the government report. Wednesdays, export prices, month over month, 630, 630, 230 crude oil. It's going to be a quiet week. Not till Thursday, retail sales come out at 6:30 in the morning. That'll move the market. That's why it's red. All right. Retail sales coming out at 6:30, 7:15, 8 o'clock business inventories, blah, 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 blah. Goolsby, there's our favorite Fed right there. On a Halloween afternoon, 9 a.m., Fed Goolsby gets to speak. All right, and then building permits come out on Friday. So, well, that's it. Boy, this is going to be a quiet week. Quiet week in the markets. Might be good to do some wild eye, crazy eye, iron butterflies. Actually, we'd have to change things up. Let's go over and I'm going to show you what happened with our wild eye, crazy eye, iron butterfly last week. We put one on Friday, remember? And on Friday, we made about $1,500, $1,500 on our sold options. Okay, so we made $1,500 on our sold two options. We sold a call and we sold a put. There's the market opening. and we're up $120 today. I'm going to just, because it's in the green and it's tanking around, and it was like, what was it? Several $100 earlier. I'm just going to take that off. Let's just liquidate that while it's green. Liquidate the multi-leg. Go ahead. We could leave that running all day long if we wanted to, but I'm just going to take it off right now. So we made $105 on that one, right? $130. So we closed that out at $130, and that's the long call and the long put of the Wild Eye, Crazy Eye, Iron Butterfly that we put on Friday. So on the short call and the short put that we put out on Friday, we made $1,500. So today we just made $130. So total, when we put those things together, we made about $1,600 in the last 2 days on that. That was good. Now on Friday, this thing was down about $500. So you had to take away the 500 from the 1,500. So it was only up $1,000. But over the weekend, and the markets moved quite significantly this morning, it brought it up out of that 500 into the $130 range. That's one of the advantages of doing that longer term call and put, right? So what we're really doing is with the Wild Eye, Crazy Eye, and Butterfly, this is not really a butterfly. I mean, it kind of is, right? I mean, really all we're doing is we're buying a straddle, and we're using premium that we sell to reduce the break-even point on that straddle, and we get to collect the premium on that. And so what happens is the long call and the long put don't have to move nearly as far. Oh wow, look at it take off. We should have hung on to it for a little bit longer. But the market doesn't have to move as far to get to break even, right? So you get to keep all that premium, and that just reduces the cost of your long call and your long put. And then those don't have to move as far to make money. So if you're just going to say, well, I'm just going to buy a straddle, or I'm just going to buy a strangle. Well, a straddle or a strangle is very expensive. So, and then the market has to really move a long ways just to break even. So what we want to do is we want to significantly reduce the break even on that long call and long put, which is multi-days long. And so we sell a call and a put and collect premium, which significantly reduces the break even points. That's what we're doing. I call it a theta swap. All right. So that's kind of cool, right? And we played with those Wild Eye, Crazy Eye, Iron Butterflies, and we did that for a long time. I mean, we got kind of bored with it for a while. So we did it so many times. But we experimented with many, many different ways. And that's what we do in this class. So if you're interested in coming to a class that does a lot of experimentation with a lot of different strategies, then you're in the right place. If you want one place that you go and just watch one guy do one thing, because he's found what he loves and what he wants to make money on, and just he does one thing every day, and it's just the same thing every day, and he's just doing that one thing every day. It's not this channel, all right? Because we do lots of different things. We try all kinds of stuff. That's what we do here. And so if you guys who are members like to come and try lots of different things and stuff, then come here, and we're going to do lots of different things. And then you take the best of what we learn and you create your own strategy. All right. So and then I think that you should eventually get to the point where you just do that one thing. All right. One or maybe two things, because you got to learn what all this stuff is so you can put it together and understand it into this one or two strategies. And so then that's just kind of what you kind of focus on, and you become an expert in that area. Now, I'm going to teach you lots of different strategies. And if you guys want to, now this is the way I like to run this class. If you go off and you find some guy on YouTube and you're like, hey, this guy, and I know y'all go watch other YouTube videos. I mean, I'm not saying not to, you should. It's fun. It's entertainment. It's edutainment. They call it, right? I call it financial entertainment. But a lot of these guys, they're teaching you different things. And so you're learning all this other stuff. And then what you can do is you can come here and you can say, hey, Lan, I watched this guy on YouTube and he did this thing called XYZ. Can you show us what you think of that and how you would implement that and how you would do it? And we can talk about what other guys do and what other guys are teaching you. All right. And what other guys are showing you, because they all have all these advertisements. When I learned this, I became rich, rich, rich beyond my wildest dreams when I learned this one thing, right? It's very clickbaity. There's only really a couple of guys out there that I'd recommend that you go watch on a regular basis. One of them is Ross Cameron. I really like Ross Cameron. I've mentioned him on numerous occasions. He's one of the most sincere guys out there. But the problem with Ross Cameron is that he trades in a way that I don't like to trade. I can't trade like him. He's fun to watch though, because he does trade real money, but he trades pump and dumps. So every morning he gets up and he watches a pump and dump, uh, watches the stock market for pump and dumps. And what are pump and dumps? Well, he likes to trade the little, and he's not trading penny stocks, but he's trading just the closest thing to a penny stock he can get without being a penny stock. So just barely above penny stocks. And then he watches for something that's bursting really hard and running on news, and he's scalping little teeny pieces out. So he's trades really, it's really hard to trade like Ross Cameron, but he's really super smart, and he has fantastic videos on his YouTube channel, and he teaches really good stuff. So if you want to watch somebody besides Lan Turner, who I believe is really super good, you would watch Ross Cameron. All right. But I don't know if you can trade like him. I can't trade like him. He's a wild man. All right. Trades those pump and dumps, and he trades some explosive stock market very first thing in the morning, and just scalps little itty bitty teeny pieces out of the market. It's really super hard what he does. All right. So, but he's a good teacher. Good teacher. And so what I want to do though today is I want to teach you about the simple basic structure of the market. And I want to talk to you about it in the simplest form of trend lines. So this is pre-market session. So the market's been pretty quiet. Of course, we're getting some movement in the market right now. And we like to let the market go for about the first 10, 15 minutes and see where it's going to establish a trend, right? And we mark the highs, we mark the lows, we do all that kind of stuff when we're just kind of first watching. You can jump into the fray right here, and you can jump in if you want to. It's really hard to trade this very first few minutes. And I'm on a 2-minute chart. All right. So if we go over and I'm on the S&P because I want to trade options. So, and in the futures market, we don't have day trading pattern rules, all that kind of stuff. So we can just trade with small accounts, and we can trade to our heart's content. There's nothing stopping us from trading all we want. But I want to trade today with options, and I want to show you a neat little tool, but I want to show you progressive trend lines. We can go down to a shorter term time frame. This is a range bar 6 chart, which is going to be, right, you're going to get little tiny moves are going to be more accentuated. So you can draw your trend lines in there, and you see me do this all the time. I come in and I say, look, there's one up for every down, one up for every down. So if we take our trend line tool on this smaller time frame, and we can start seeing where the market kind of opened up in here and started making trends. So there's one up. Let's see, let's lock my toolbars, tool button lock. There we go. So one up for every down. So you can just draw your trend lines in there. One up, one down, one up, one down. And usually what we're looking for is we want to see a lot of flat bottoms on the range bars, right? And then a lot of flat tops on the range bars coming down. Red bars down, green bars up. Red bars down, green bars up. This is the simplest form. I only have one indicator on there, and that's the VWAP. And we could even turn that off for now for this study. All right. So we're going to turn that off. The only thing we're really worried about, I got the MACD down in here, and you can see kind of the swoopy little things on the MACD, and that's kind of helps you see where the trends are moving from bullish to bearish and green to red, right? But nonetheless, what we're looking for is we're just looking at trends. Now, these are not progressive trend lines. These are just normal old trend lines. Now, the thing about trend lines is that trend lines are also fractal. Fractal, what does that mean, Lan? That's a big word. Yes, it is a big word that means a little thing. What it means is that there's little trend lines inside of big trend lines. So this, you can see all the little individual trend lines. But in reality, if you come in here and you delete all those, we have one trend line, which comes all the way up here, right? So in fact, we could probably even go back farther. So this trend line goes all the way back to here. So this is what I call a progressive trend line. And trend lines are fractal, meaning that you have little trend lines, right, inside of bigger trend lines. And down here, this is pre-market session. So the trends were kind of little tiny in there, little bouncy around, lots of false breakouts. But you get, as we started going into the market open and more people come and start participating, then we start getting the more fractal trend lines, right? The little trend lines like this. And you're like, well, how does this help me, Lan? How does this help me be a better trader? Well, it helps you understand market structure for one. You want to be able to understand how markets move through price and time. And that's very important. And so what we want to do is we want to decide what type of trader we want to be. And I talk about this all the time. You have to kind of define what kind of trader you want to be. Do you want to be a scalper? Do you want to be a day trader? Or do you want to be a position trader or a swing trader? Now, these things have different connotations to them. And so I always like to say in our class, we want to get our definitions straight. And the reason we want to get our definitions straight, and a lot of people are just like, oh, why do you even worry about it? We just trade. Well, we want to worry about that kind of thing because we want to be able to talk to a community of people and be intelligent about what we're saying, right? We don't want to sound like an idiot. I don't know what a scalper is. I don't know what a day trader is. I tell you a funny story. I went to a conference where I was a speaker, and it was actually down in Puerto Rico, the University of Puerto Rico, and we were speaking to the graduate students down there. And I was an invited guest, and they had this big conference room, and it was full of students, right? There's a whole bunch of students in there. And I was not the only speaker, obviously. They bring other people down to the university to speak. And one of them was from New York, and he was an old options trader. Not an old one. He was a young options trader. He's a young guy. He's younger than me. And this was a few years ago. So we were both pretty young guys, but it was pretty interesting because we got in there, and my whole speech was about, my favorite stuff. It's Fibonacci, Elliott wave, and accumulation distribution, right? Count, measure, setup, trigger, follow through. This is what I teach because I learned that at the Chicago Board of Trade, and I know that's how the big boys do it. And so that's what I like to run around and tell people what I learned at the Chicago Board of Trade. So I was going to teach people about Fibonacci and Elliott wave. Well, I got up and I spoke and I told him, I was ahead of this other guy. And I said, this is what an Elliott wave is. This is what a Fibonacci is, and this guy comes walking in halfway through my speech, so he didn't really hear the whole speech. He's kind of an arrogant guy, and he comes in and he sits down, and then he gets up and speaks, and he goes, "I don't trade no Fibonacci and Elliott wave. I just trade these here ABC tools, these ABCD patterns." I put my hand in my face in my hand, and I looked over at the guy that was sitting next to me, who was actually the instructor who had brought us all down there, and I said, an ABCD pattern is an Elliott wave. That's what an Elliott wave is. It is an ABC pattern. So for him to stand up there, I don't trade no Elliott wave. I don't trade no Fibonacci. I just trade these here ABCD patterns. I was like, here's this arrogant guy from New York. That's what an ABCD pattern is. It's an Elliott wave. It's just two ABCD patterns in a row. I bust up laughing. I'm like, it's just funny. People they just have a little bit of lack of education, and they're arrogant, and they think they know everything. And it's like, if you would just learn a little bit, you can speak intelligently. It's not hard. I mean, you're in the industry, you're trying to be an industry player. Why don't you just learn a few terminologies? And so that's what it's about for me. It's just learning how to speak to people so you sound intelligent. So you don't sound like an idiot in front of a big audience. Just learn the terminology. That's all it is. I mean, if you're going to go and be in the computer industry, you probably want to know the computer terms. Every industry has lots of different terms. Now, I have some pet peeves about this market because in the financial market, some of these terms get bastardized. And I'm sure just like in any industry, people, change the terms around. But I like to define them for our class. So if you're going to be a scalper, you're going to go for very short-term trades, all right? You're going to go for these little tiny moves right in here. These are scalpers. This is what a scalper does. He goes after these little tiny moves like this. Now, Ross Cameron, I love Ross Cameron again, but he goes for little itty bitty moves. He'll go for like a 2-bar move. He's in a market for like 30 seconds and then he's gone. Or even less. Popping, he's out, popping, he's out, popping, he's out. And he's getting in and out, in and out, in and out, up a whole trend. He doesn't even try to ride it up a scalping trend for me. I mean, he takes scalping to a new level. He really jumps in and out a lot, but he makes a lot of money. So I love the man, think he's wonderful, but I cannot trade like him. So the whole idea here is to identify, what am I trying to do here? And not get confused, because a lot of guys will get in, they'll say, well, I'm a scalper today, or I'm a day trader today. And then when the trade goes against them, suddenly they're not scalpers anymore. They're not day traders anymore. Now they're position traders or swing traders, and now they're holding a position forever, waiting for it to come back. So they switched their strategy up from one to the other midstream because it didn't work out the way they thought it should. And so that's not a good strategy either, because you don't want to, like, okay, I'm going to be scalping today. And then when the market goes against you, you're going to hang on to it. And then we call those bag holders. All right. People who get into a position doesn't go in the direction they anticipated. And so then they're losing money. So they just stay in it, and they stay in it for days and weeks and months, just waiting for that scalp that they were supposed to be taking $200 off of. Now they're down $6,000 waiting for it to turn around and come back so they can make their $200. So don't do that. Don't be that guy. All right. So we're going to identify trend lines and realize that trend lines identify for us and help us identify whether we're a scalper for the little tiny trends like this, whether we're a day trader. And this is, this is all within one day. So a day trader is somebody who tries to get into a position in the day and stays as long as they can, as long as there is a trend. And then when the trend is broken, they either go the other direction or they're done. So this is a day trader trend right here, this whole long thing so far. So you're staying in longer. These are scalps. These are trends. So this is a day trader. And then if you're going to stay longer, if you're going to stay overnight in a position. So let's say if we go out to maybe a 4-hour chart. A lot of guys like to trade 4-hour charts. I don't even have one on here. I don't trade 4-hour charts, but we'll do it. And I'll show you. Well, let's just go to a 15-minute chart, because even a 15-minute chart is generally a time frame in which you can trade overnight. But you can see my trend lines in here on this 4-hour chart. And if we remove all these little trend lines in here, then we're going to have just kind of a longer trend, right? And this is what you would trade if you were trading a 15-minute chart. 15-minute chart, fine, it's great. Nothing wrong with trading 15-minute charts. You just have to realize that when you get into a 15-minute chart, that your risk for hanging on to it is a little bit larger, because you're going to, let's see if I can figure out this new feature they put in the software. So if you get in, let's say you get in here, well, the distance on a 15-minute chart, that's $235, right? So from top to bottom is around $200. So you're going to risk $200 to get into this from your stop entry to your stop exit, where you'd get out if you were wrong. Of course, you're going to stay in longer and you're going to make more money. So there's a $1,200 move, right? So if you go to a 15-minute chart, you're going to go to a 15-minute chart because you're planning on staying into a market a longer time. You want to catch these longer trends. People ask me all the time, when? How come I can't make $30,000 a day? There's guys making $30,000 a day, or they make $30,000 trades. How do they make $30,000 trades? Well, they stay in longer. They go out to a longer term time frame. They trade longer trend lines, and they stay in longer to a market that's moving bigger. They have bigger accounts, so they can risk more on the entry. And it all has to do with how much are you willing to risk on the entry to find out if your trade is right. And that's what trading is all about. How much am I willing to risk to find out if this market's going to move greater in my favor, right? So if you come down to a smaller time frame, 2-minute chart, well, a 2-minute chart, and you get in, the distance between where you're going to get in, where you get out, that's only $100 in that case. And that took in 3 or 4 bars. So if you go in here, it's $150. Or, you get in and it just depends on how much are you willing to risk. And on a smaller term time frame, so let's go down to a range bar chart, range bar 6, and then you can look and you can say, oh, well, how much is it going to, let's put on Heikin-Ashi here. So you can risk, a much smaller amount. So there's $125 on your entry, and this is on the S&P. So on your entry versus where you'd get out if you were wrong, where you're going to get in, where you're going to get out, much smaller distance, therefore it's smaller amount of money, therefore it's a smaller risk. So what I like to do is, if you're going to get in, I like to get in on a smaller time frame. And a lot of people tell you not to do this, but I like to do it. I like to get in on a smaller time frame. Once I'm in, if you want to try and stay in the trend longer, see, you get into the fractal trend, and then you say, well, I'm just going to get out when it gets up here. Okay, well, great. That's a $500 move. Oh, well, that's wonderful. What about just right there? Okay, we'll get out right there, just on when it turned green again. Well, that was a $487 move. That's pretty good money. But I want more. I want to have one of those longer term trends. Okay, well, go for a longer term move, but then you have to give up some of your profits. So let's come in here and you say, okay, well, I'm going to be a day trader today. I'm not going to be a scalper. Okay, well, that means we're going to go for a longer term trend. We're going to go across here, and then we're going to go up to this one, and we're going to be willing to take bigger risks, right? So we have longer term trends, and you're going to be willing to sit through a drawdown against your position of, in this case, $225. Whereas you were up 500 or $600. So you were up from low to high, you were up $600, but you're like, well, I want to go for a longer term trend and make more money. Okay, well, you're going to have to sit through a drawdown of $225 just to find out if it's going to bounce off of your trend line and then start to rally once again and go up and make another $600. So now you can add your $600 minus your $200 plus your $600, and that's going to be the total move of that move, right? Does that make sense? So it's going for longer term trends. And that's what you can do when you have more staying power. That's why I like to trade options, because then we can say, okay, well, we have a little bit more staying power and we can stay in it longer. But then you can go out to longer term time frames and it's easier to see a longer trend. So when you draw your longer trend, well, now it's not so ugly. But you still have these little pullbacks in here. They're just smaller. So now that's another, $362 move on the way back that it pulled back against your position. So you have to decide how big your account is, how much money you have, and what you're willing to risk, and whether you want to take smaller trades and take more of them, or longer trades and take fewer of them and stay in the market longer. If you want to go out to a 4-hour chart, so a 4-hour chart would be 60, 120, 240, right? So 240 minutes. We go out to a 4-hour chart. Now, when you look at a 4-hour chart, this is your S&P 500 4-hour chart. Each one of these lines, each one of these vertical lines in here is a day. So now what we do is this is one day, and we're going to stay in the market for, what? Are you going to stay in these trends like this long? How long are you going to stay in this market? And that's okay. There's nothing wrong with that. It's just, is that how you want to trade? Are you going to trade on a 4-hour chart and try and stay in these markets for a longer period of time? And if you're going to do that, I would recommend you do it with options rather than with contracts. But people do it with contracts too, certainly do. And you can go to different markets and they'll have different trends. And you can, here's a little counter trend coming in here. So you have your ABC pattern. I don't trade those Elliott waves. I just trade these here ABC patterns. So there you go. There's a little ABC pattern, but it's on a bigger time frame. It's on a 4-hour chart. So if you want to trade these 4-hour charts, I like to start on a smaller term time frame. Get in. Once you get in, move your stop to break even, and then move out to a longer term time frame and let those markets run and see if you can't catch a longer trend. And then that's how you make bigger money, right? Rather than saying, well, $500 is my goal for the day and I'm going to be happy with $500. Well, now I'm not happy until I make $30,000 in one trade. Okay, well, you're not going to do that scalping unless you trade, 100 contracts at a time. And you can do that. I mean, if you think scalping is a lot easier, rather than moving up to longer term time frames and saying, well, I'm going to still only trade with 1 or 2 contracts, but I'm going to hold them for 5 days, you can do that. Or you can say, well, I'm going to come down here to range bar 6 and I can find these trends here. These are easier to identify and I don't have to wait for drawdowns. And rather than just trading 1 contract, I'm going to get good at it and I'm going to trade with 10 contracts. Okay, we'll do that then. Then you can trade just this one with 10 contracts. That's what Ross Cameron does. Only he doesn't even trade that full run. He'll trade 2 price bars with, 1,000 shares of stock. And so he trades just a tiny little bit. And then when it pulls back, he gets in again, trades a little tiny with thousands of shares. And he can make a lot of money, makes $1 million a year doing that. So it all depends on you and what your comfort level is. Well, what's the right answer, Lan? Just tell me what to do. I can't tell you what to do. You're going to go out to YouTube and you're going to find different people telling you to do 10 million different things. And that's what they're going to tell you. They're going to say, oh, you should stay in longer. Oh, you should just do quick little scalps with a large quantity. What do you want to do? It's up to you. You can experiment and practice with all these strategies. And I would recommend you do that. For me, what I like to do is I'm kind of an A-type personality. I don't have a lot of patience. So that's why I like options, because they force you to have a little bit more patience. But I kind of like to trade on smaller term time frames and take these little more obvious trends like this. That's a good little trend for me. I love that. This little green trend here, I would like to stay in that whole thing. Ross Cameron would get in and out of that thing 1,000 times on the way up through that one little trend. I like to get in here and I like to get out there. That's kind of where I've ended up. Out of all these years of doing things, I like to get in here, get out there. The problem is that sometimes they're not that obvious, right? And so you start getting beat up trying to get in. that's where you have to have patience. And you say, well, it didn't, my strategy didn't work on that one. I'm just going to sit aside and wait for the next one. And so sometimes the markets will just sit there and go sideways, right? Like this, and you keep trying to get into one of those green trends and you get your hiney handed to you. That's where you have to have risk management and say, well, I'm not going to trade then because the market's not trending for me properly. I've tried to get in a couple of times and it's failed and I can't make any money. So sit aside and wait until Fed Goolsby comes along and speaks and makes the market move and start to make these little green trends. And that's why we watch for Fed Goolsby to come along and speak, because he's going to cause the market to do this. Whereas without a Fed Goolsby speaking, right? Without Fed Goolsby, we're going to get a lot more of this kind of stuff. And this is harder to trade. Now, sometimes you get the Fed coming in and changing an interest rate, right? And when that happens, the market goes so wild and so crazy, you can't trade that either. So there's times where you can't trade. You just simply can't trade. The markets are not tradable all the time. There's kind of a little sweet spot where you have to kind of wait for the market to get into these little sweet spots. And then that's where you trade your strategy. And so it depends on whether you want to stay in longer or shorter. So again, I kind of show you what I like to do, which is catching these little green runs like this. That's my favorite thing. And then I like to catch it. And then if it moves, I like to add in as quickly as I can and then peel off. Add in, peel off, add in, peel off. That's a $562 move. But if you do it properly, you could end up making several $1,000s on that one little trade. And that's a fun trade when you can catch those. All right. So I like to just watch for these little trends and counter trends, trends and counter trends. And when you can identify that the market's moving through these trends and these counter trends, right? Each one of these little counter trends is a trend line that you're drawing, that you then draw your trend. And so it's all about trends and counterline trends. We generally get 3 big drives in a row, right? Drive 1, drive 2, drive 3. Now, in this case, we've got 4 drives, which is really quite strange, but we're down on a range bar 6, which is a tiny little time frame. So you'll get more than 3 drives on the little tiny time frames. But once you do start getting up there, you have to start realizing that, hey, the probabilities of this thing continuing higher without a nice rebound or a nice pullback is getting slimmer and slimmer. So you go out to a longer term time frame. So if we go out to a 2-minute chart, you're going to see, well, in this case, man, this market's really doing well today. We should be trading instead of lecturing. But you can come in here and you can see that we've just got, at this point, just one nice big long trend, right? This is a 2-minute chart. And that's not even a very long chart. It's still only 2 minutes. 1 minute is okay. 1 minute gets a little choppy. I kind of like to go out to 2 minutes so that it kind of is not quite so choppy. But that's just all one big trend. But you can see in here all the little trends as the market made lower highs. So in this one, you can see the 3 drive pattern of the Elliott wave a little better. Let's stretch that out a little bit. But you can come in here and you can see, okay, the market rallied up. It had a pullback, had a lower high. Then it rallied up, had a pullback, had a lower high. Now it's rallying up again. We're in the 3rd drive on the 2-minute chart. Do you see that? See how that's fractal? That's why we call it fractal, because you're going to get different frames based on the markets that you're looking at or the time frame. You come down to the range bar 6, which is a little tiny, right? Versus a 2-minute chart. This is a 2-minute chart. Each bar represents 2 minutes. Range bar breaks all those 2-minute charts up. Okay. And the reason I do that is I like to come down to the range bar chart is because one price bar back on a range bar chart, in this case, is $150. So you're risking $150 just trailing your stop one price bar back from the current market. Or when you first get in, you're going to risk $150 just to find out if the market's going to move in your favor. If it's not, you're going to lose $150 just to have it say, no, I'm not going to go in the direction you thought that I was going to go. So you're risking $150 every time you get in. Well, if you come to a 2-minute chart, no, you're going to go one price bar back, right? Just one price bar behind your entry bar. So if you got in on this green bar, that's $400. Okay, now I'm no longer risking $150, which you thought was a lot of money to lose just to try and see if the market was going to go in your favor. Now you're on a 2-minute chart, you're going to risk $425 just to find out if the market's going to go in your favor. That's why longer term, bigger charts are more. You need bigger charts, bigger markets, bigger accounts, all that kind of stuff, which is why I don't start on 2-minute charts. Even a 2-minute chart, being as small as it is, it's only 2 minutes. It's not a 15-minute chart. Again, you go to a 15-minute chart, one price bar back is going to be, a lot of money. 15 bars, 15-minute, that's $325. So just to be from the break of red bar to green bar. So you're going to have a bigger account. You're going to have bigger cojones. You're going to have everything's going to have to be bigger if you go to a bigger time frame. That's why I like to start on the small time frames. And if I'm going to try and move out to a longer time frame and say, well, I'm going to hang on to it longer and take a bigger risk, well, I'll start on a tiny time frame. As soon as I'm in, got my stop to break even, I can move out to the 2-minute time frame. Now I'm going to start taking bigger risks in here, which means I'll get stopped out if you might get in with a larger amount of money and you're up $400, $500, $600, but then it comes back and stops you out with a break even. And you could have made $400 or $500 if you'd have just stayed on your range bar 6. But this one came back and stopped you out, and you didn't get out at the top with a little scalp. Does that make sense, what we're doing here? And that's why we do what we do. And you have to decide what your strategy is. Again, if you're going to try and stay in markets for a longer period of time, that's why I like to use options, because then you don't have to worry about every little tiny flaky move. But you can. So what I want to do is show you the progressive trend line. So again, what we've got here is we got you can see through the past that we had all these little trend lines coming in here, and it's the breaking of the trend lines, right? It's the breaking of these trend lines where we get our triggers and our setups for entry. So right here, this is your buy signal. You say, well, why didn't you get a buy signal here, Lan? Well, it went green, but it's kind of tiny there, and you kind of want to have 1, 2, 3 hits along a trend line for it to be considered a trend line. Otherwise, it's just a little bump in the road, right? So if you're going to look at a trend line, these little 1 or 2 bars, you have to kind of be willing to sit them out for a second and see if you're not going to get a longer move in the market, and then even a longer move in the market, right? So that's the idea. It's the multiple hits along a trend line. It's the multiple hits along the trend line that'll extend the trend line and see how long that trend line is going to go, or how long you decide you want to stay in it. That's the difference. What's the right answer, Lan? There is no right answer. The right answer is what you feel like the market's going to do, and whether you're going to just trade the little tiny moves or the bigger moves. So you draw your trend lines in there. Now let me show you a progressive trend line. So that's the kind of the fundamentals of trend lines. And trend lines, again, are probably one of the most powerful tools that we have, which is why I use mathematically calculated trend lines, all right? Because they help us know where to draw our trend lines. So when you get a situation like this, where you got lots of little chops in there, it's easier if you can have a mathematical model help you identify where those might be. So if we set that to 1-to-1, which is kind of a nice place to be for trend lines, you can see where the trend lines are supposed to be. The trend lines with these little yellow arrows are mathematically calculated trend lines. It's called the average true range. And so you just draw your trend lines. Oh, see that? Didn't break. So came up here. So then you just draw your trend lines, and they help you know where to put your trend lines. And you're just going to buy every time it breaks above a trend line and sell every time it breaks below a trend line, just like that. And if the market's trending and moving nicely through a nice trend like it is this morning, you make a lot of money, right? Just get in right here. Just get in right there. Get out right here. Get in right there. Get out right there. Now, it doesn't always do this. This is pretty rare to see a market do this beautiful of a trend today. But this is trading on a very small time frame. It's range bar 6. So we come down, we go to a 2-minute chart. This would be kind of, same thing. Let's turn on our mathematical trend line. So we're going to come in here and ATR. There's our mathematical trend line. And you can see on a 2-minute chart, it's all one big trend. It's just one trend, just like that. And it just broke it right there. So there's your 2-minute chart trend break right there. Now, let's do a progressive trend line. Let me show you something really cool. Track and Trade we build into it this really cool feature. All right, so we're going to take our trend line. We're going to come over to the preferences. You can see we have snap, extend right line, and then force horizontal. So let's come back over to the range bar 6 chart so we can kind of have more to work with. So I'm going to turn off our magic trend lines, our mathematically calculated trend lines, and we're going to use the progressive trend line. Now watch this. It's kind of cool. Let's just do this big long trend here. So I'm going to come and I'm going to start at the bottom where it went from red to green, and I'm going to click in there with my trend line, and I'm going to take it and I'm going to attach it because I got in my preferences. You can see I got it set to snap. These a little teeny tan trend line. See, it's only 2 bars. So 2 bars does not make a trend, but that's every trend starts with 2 bars, right? So when you get your red to green, you put your trend line in there and you have it set to snap. And then I like to turn on extend line like this. And then the farther it gets up the trend, and you can go to every new bar and it snaps to the bottom of every new bar. And eventually you're going to get a little pullback like this. See that? And then the market's going to start to go up again, and you're going to continue snapping to every new bar. And as long as the market stays above the snap, you stay in. And it's not until the market breaks a red bar below the snap that you get out. There it is. So that's where this whole trend stayed green this whole time. The market stayed above it until it got to that snap. Now, this is kind of, and then what you're going to find that you're going to turn on your mathematical calculated trend line. And so we're going to turn on ATR, and you're going to get basically the same structure, but you're going to use that in combination. So again, watch this. We're going to start here, and we're just going to move every time we get a new price bar, we're going to move it up. And now we got a kind of a nice little pullback in there, and then we can just keep moving it up, moving it up. Now, once you get to a certain level, and the market's going to move sometimes a little bit more, it's going to move up, and then you're going to have a little bit better pullbacks, kind of like this right here, right? So eventually you can start drawing more than one trend line. You can say, okay, I've got to a good stopping point, and we can say, hindsight's 2020, and you have to get good at doing this on the fly. But you can see it's kind of stopped right there and started going up again. Well, it started to go above this lower point when it gets up in here. So then you can bring it back. You say, okay, well, I'm going to leave this one on that low point, and I'm going to start a new one. And then you can start a new one at that low point, and then you start drawing it up, right? Like this. And this is how you get these, what looks like a little laser light show. So now you get multiple trend lines coming up in here, and you can decide where you want to, but as you bring them in, you extend the line. Let's just turn that on. We're just going to save that. And then you get your trend lines, and then you just move the progressive trend line across each high and low. And then when you get a full, complete open, high, low, close bar, changes the other color going the other way. Well, that's your signal right there, red to green. It's pretty obvious, not on this market, but it's not always that obvious. So you just try your trend line. So you go from here and you go to the first one, the second one, the third one, the fourth one, the fifth one. You can decide if you want to stay in it and then say, well, let's see if we get a second bar above. No, staying down there. And then you got your 2 points. So now you got your two points, point one here, point one here. Now this is a counter trend, but that tells you where your crossover is, which should match up with your mathematical model, which is the ATR. And because we use the ATR and we get comfortable with it and we understand it and we have that turned on, you'll oftentimes see us come in, we stop drawing our trend lines. We don't draw our trend lines because we're trading. We're actively over here trading, and we're just watching the yellow dots instead. And then, of course, we can attach our stop orders to the yellow dots. Now, the yellow dots oftentimes get too close, and the market comes down and touches them, knocks you out if you're trailing too close, which is why we have another trailing dot system. We turn on the bulls and bears, and you get a blue light in here. All right. So this one holds your stop further back. And it depends on how aggressive you want to get with that. You can move that, and then that line can be a longer term trend, right? You can tune it in to be a longer term trend and try and catch all these lows where it's going to touch along the line. And you're going to draw your trend line, right, where the blue lights are. So you're going to come in here and you can say, well, this blue light's from here to here. And then I can extend out along that blue trend line where that nice long trend line is. Or you can come in and you can go back to the bulls and bears, and you can desensitize it, and you can bring it up in here, up into I like 72 for counting Elliott waves. So that's the number that we've done a tremendous amount of back testing, and that's how you get your multi-drive patterns. So we got drive 1, we got drive 2, we got drive 3, and we got the unicorn drive 4, right? Really rare to get 4 drives, but there's drive 1, drive 2, drive 3, and then on this one we got a 4th drive today. And that's in the range bar 6, which is going to be more common to see 4 drives than on a longer term time frame. But there you go. There's how you draw your trend lines. Now, how's that going to help me trade, Lan? How's that going to help me trade? Well, you're going to stay in the market as long as the market is above your trend line. And then when the market crosses below your trend line, you're going to get out. And if we're going to try and stay in with options, which is what I wanted to do today, we're going to try and stay in when we get multiple hits along the trend. So if we come in here and you can see there's our beginning down here, we now have our first hit right there. There's our second hit. There's a third hit. So let's come in here and draw that trend line in there and get the progressive trend line on there. So we're going to go from 1 and we attach it and we have the extended line. So there's your first trend line. So there's your A, B, C pattern. So you're going to go from the bottom of the A up to the top, down to the B. So there's your second hit right in there. And you're going to, hindsight's 20/20, so you can put that in there like that. Now you know what this trend is all the way up here. And as long as it stays above the trend, you're going to stay into your option. All right. You can do the next one. Now you can come up here and you can, so you're going to come up here and you're going to go to this one and then down to that one. There's your next trend line. See that? And then you're going to go from this one. You can go from this one up to this one, which is the high, down to this one. There's your third trend line. And there you go. There's your Elliott wave. So now you're drawing in here your 3-drive pattern. So there's drive 1, there's drive 2, there's drive 3. And this one again went up to drive 4. So we're going to draw it again. We're going to come in here and we're going to go from the 4th point up down to here. And now you can say, well, okay, it's starting to come out. It looks like a head and shoulders formation. The top of an Elliott wave is where you get these reversal patterns like a head and shoulders. So we're going to watch for a right shoulder up in here, see if it won't bounce up there. If it doesn't, if it breaks below our trend line, this would be the end of the trend, right? So that's how you do it. That's how you do progressive trend lines. So the progressive trend line can be kind of a fun thing to do along the individual trends themselves or along a longer term trend line, and you can just stay in as long as it's above your trend lines. And you keep drawing your trend lines as long as you have multiple points to hit. And yes, you can do it on a smaller time frame. You can come in here and say, okay, here's a trend from here to here. Okay, so as long as it stays above the trend line, you would stay in. And you can do that on each individual fractal. So you come in, you can do that here too. You can come in and say, okay, it's going up the trend. As long as it stays above the trend, am I going to come down? How far down are you going to let this thing come? 1 bar, 2 bars before you decide it's broke the trend. But you can see that you've also got your mathematical calculation, which is helping you as well. And that's where you get your counter trend. So we have trends and we have counter trends, right? So the trend is your friend until it bends or ends. So for a longer term trade, you want to stay in as long as it stays above the trend lines. And you can go multiple trend lines, trend line 1, trend line 2, trend line 3, and get the entire Elliott wave all the way up. Or you can come in and you can trade the shorter term trends and then calculate the counter trends, right? So the counter trends are the hard parts. You don't want to trade down the counter trends. And the counter trends are usually choppy. All right. That's how you know it's a counter trend when you're using these Heikin-Ashi bars, because the counter trend is choppy, whereas the trend is smooth. And the trend is generally longer. The counter trends are shorter. Counter trends are usually half the distance of the full trend. That's where you come in and you start drawing your counter trends in here, doing the same thing. You can get your progressive counter trend in here and you get the first one. And again, 1 bar is not a trend, but you can start coming in here and identifying where these little pullbacks are. And you can start getting multiple points along your trend line. And then that's where your trend line is. You want to run another one? You start up here. Oh, let's get this where it belongs. Up there. And then this one goes to here. Oh, it keeps jumping on me. And then we can go from the next one. We can start another one. Come down here farther. Then you get your little trend lines coming down. It's a little bit harder on the smaller time frames to the little counter trends, but you get the idea. You're drawing your trend lines in there and you're kind of progressively following along behind the market. And so as the market moves, each new bar comes in and you attach your trend to it. As long as the market stays above your trend line, you stay in. Now, the market's just kind of going sideways here with this little head and shoulders formation. Let's kind of see. Now, in this case, we kind of think the market might just either stay up there or fall, right? But we think that the run is over. We don't think it's going to continue to go because it's made on this time frame, it's made a full 3-drive, 4-drive pattern. and we got one big long. If we put that trend line in there, let's get rid of all this stuff so we don't have a laser light show going on here. And let's see where this bottom's at. I'm going to try and bring it in a little bit. Look at this thing all the way up there. We'll go all the way from here, and we'll just bring our trend lines in like this. So that's our first trend line. We'll start another one there. Let's come up to this one like this. We'll start another one here. That one's about the same, so let's get rid of that one. Go from here to here, and you can go up from here to here. And now we kind of got the markets crossing over our progressive trend lines. Now we've got more trend lines here, and you watch, it'll be interesting because it depends on how many people draw these long trend lines and how well they're respected. It will depend on the number of traders who draw trend lines in the same place you do, and then where these trend lines get respected and not respected, where they break, right? So that one actually is not in a good spot. Let's get rid of that one, and we'll reset it. So we go from here up to here. Now we're breaking down, and that little head and shoulders formation up in there, left shoulder. So the whole idea of technical analysis is just trying to use these different tools to help you figure out where you think the market's going to go. And the guy who gets good at being able to predict where markets are going to go is the guy that's going to make the most money. That's really all it is. Again, I say it every time. It's just a big carnival game. You're just playing a game. Do you think this little snake is going to stay above where I draw these lines? Do you think this little snake's going to fall below it? Do you think the little snake's going to go sideways? And so you're playing the little snaky game. You just went down to the carnival and you're going to play a snaky game. And you're going to use all these tools to help you identify mathematical models. You're going to draw trend lines. You're going to do different tools to try and decide, well, where's that little snake going to go? And then if you get good at predicting where the little snake's going to go, you can make money. And that's what trading is. It's a carnival game. And the odds are stacked against you. The odds are stacked against you. So we use all kinds of tools to help us put the odds in our favor. Right now, I don't think market's going to make a lot of big uptrends. We got a nice little red bar there from our bulls and bears. So we could come in here, show you kind of a fun little trick. I want to do it with options. So we're going to come in, we're going to do a 0 days till expiration. We're going to come in here and we're going to sell a call option right up here above the high, $257. We're going to go ahead and we're going to sell that. Now, we might be wrong. And the fun thing about selling options is that you're going to start collecting premium as the market starts to move through price and time. Even if you're wrong, you still can maybe make some money. The problem with buying an option, let's say we bought a call and the market didn't go in our favor. Well, we've got time decay that's going to rip apart all of our premium. But if we sell a call, now, of course, I got a huge margin requirement here because it's a cash covered call. So they're going to margin me at a very large amount. In fact, let's go see what that was. Well, we can see it right down here. My margin, $15,000. So that's my margin. So if you're going to trade like this, sometimes what we'll do is we'll come in here and we buy a call way up here. Costs us almost nothing. Okay, put that up there, maybe $12. So then we come in here and we buy a market. And now my margin's gone all the way down to 1,859, from 15,000 to 1,800. And it cost me $12 to do it, but it significantly reduced my margin. Now I just leave that up there all day, and now I don't have to worry about it. I can trade in and out with this little call, with this put option here. Put it on, take it off, put it on, take it off, put it on, take it off. Doesn't matter because my margin will always only be about $1,800 because that protected me, right? So that up there just stays there all day long, which reduces my margin. I have to pay $12.50 for it. Now I can trade in and out with this option here. So the market's coming against me. So it's going the wrong way. So you can see I'm down $45. But if I was trading a contract and that market came against me from where I got in, I'd be down $137. $100 more. Of course, I make more money too, right? But this is a way of reducing your risk. You can reduce your risk. Now, oftentimes people will tell you that, and you'll hear it said all the time. I'll tell you that all the time. When options give you leverage, right? So you're like, oh, when I trade options, I make a lot more money. Not in the futures market. It's the other way around. Why? Because we already have massive leverage in the contract. Because remember, this is a hedging market. So one contract represents a lot of shares. Let's say if we're over in the stock market, we come over here to our key. All right. One contract represents $50. S&P 500 stock index currently priced at 5,896, or you are controlling $294,000 with one contract, which is why a small move is $287. So if you were over in the SPY, for example, or probably actually the SPX over in the stock market, and to make $287, you would have to put up, $294,000 into the market is what it's saying. I don't know if that's right or not. Maybe it's the $5,896 to make $287. One contract current price is $5,896. Yeah, you'd probably have to put up $294,000 to make $287, but you'd have leverage over there too. But anyway, you have a tremendous amount of leverage in the futures market, and that's the whole idea, is that you're going to hedge your stock portfolio so you don't have to have a taxable event, right? So you come over here and you buy and sell, and this protects your other portfolio. Now, if we were trading a contract, one contract, and I'm down, I'd be down $287 right now. But with this option, I'm only down $77. So it's a way of significantly reducing your leverage. So in the futures market, because you have such leverage, $294,000 is what one contract controls. So if you have $294,000, you can hedge it over here. And then you don't have to go in and out with $294,000 in the stock market. You can come over here and hedge it. That's a big market. It's a lot of money, and you're controlling that over here. That's how you can make so much money with such a small amount. Well, how much do I have to trade that? Well, you only have to have $750. So $750 is all you have to control it. So $750 would make you $337. But with the option, now we sold this option, so we're collecting premium, but it's going against us. So now we're only down $100 because it significantly reduces our risk. See that? And we have staying power. It gives you staying power because you're not risking so much. Remember how I always said, I wish that the micro minis were 5 instead of 10 or 1. 2 micro minis, I wish they would have just cut the S&P in half. So with an S&P 500, you go down to the micro minis, it's 10-1. So it takes 10 micro minis to make one mini. And I'm always like, well, that's too small. 10 is too small. I wish they'd have only just cut it in half and done 2. Well, that's how you do it. You can do it with options. You come in here and you put your option in. Now you're not 10 times smaller. You're only 5 times smaller, half the size. And of course, in here, when we sell an option, we have unlimited loss potential, right? But that's the same as when you sell a contract. If you buy and sell contracts, you have unlimited loss potential. If you sell an option, you have unlimited loss potential. But the difference is that in this case, if we were in with a contract and we would have taken a short position right here, right where we got in, right now we'd be down $262. Up here, we're only down $132. So it's half. That's pretty cool, right? And you can trade these by putting them on, and then you got theta or time decay working in your favor. So theta or time decay working in your favor, meaning that the longer it goes, it's going to decay. Now, of course, the maximum amount of money you can make with this option is $262. That's your max profit. And we're already down $152. So we let this go a little bit too long, but I was showing you an example. Let's just leave it there for a second. What if the market turns and falls back down? You're like, Lan, that's a bag holder. You said not to do that. I did, didn't I? Don't do that. Don't be a bag holder. We could get out, but if we think it's going to turn around and fall back down, we stay in. Just don't hold it for days on end. You can't because it's going to expire at the end of the day anyway. So this is a little double top in here. We'll just wait and see if it wants to turn and fall right now. Back down here. We could put another one in too. Not very expensive. Let's put one in. So we'd actually have to have, otherwise we have to have two of these. If you're going to trade more, you have to add another one. So it come up here, we go. And we're going to buy a call up here, buy another one. So now we paid $25 for our protection. That significantly reduces our margin requirement. And now we can come in here and we can sell a call. $250 up there. And we'll just mark it into it. Oh, didn't like it. Oh, there it went. It failed. Now if the market falls, now we have two of them. Now the max we can make is $500. But the market needs to fall. But it doesn't even need to really fall. It just needs to not go up anymore. If it just kind of wanders around right in here, we'll still make money because of time decay. We just don't want it to go up here. And it's a slower way of slowing things down and not being so freaked out and worried about all your stops and trailing stops and all this stuff, because we're getting up here. As long as it stays below our trend lines, we can stay in. It goes above our trend lines, we want to get out. But right now, we got this little stair step case of trend lines that are coming up that we're drawing, and breaks below the trend lines. That's when you're supposed to get out, right? Get in. So these are short positions. The both of them combined, we're only down $100. If it just keeps going straight up, well, we'll want to liquidate them. Slows things way down from the way we generally do it when we scalp and trail, huh? Well, on my long-term trades, my real money trades, I'm glad to see that thing shooting off like a rocket ship. I told you the other day we got a buy signal, and I was like, well, I hate to be buying right here, but I am. But I got a buy signal, so I have to take it. So it's one of my favorite buy signals, so I took it. And man alive, today, let's see what this thing's done. I'm curious. I got my real money account over here on my other screen, so hold on a second. Oh, ooh, ooh. That's nice. Hold on. That's been a nice run for me today. I'm up $3,000. Can't complain about that. See if it continues to go. We got our little options in here. Let's go out to a longer term time frame. Let's go to a 15-minute chart. So, oh, what happened? Come back here. Delete all the drawing tools. Now let's do our progressive trend line. We can draw it all the way up to there. Look at that, still above our trend line. We got a couple little counter trends in here, didn't we? So we got a little counter trend here. Oh, got another one, a little counter trend here. So on the 15-minute chart, this is drive 1, this is drive 2, and we're going into drive 3. And look, we got a red to green on the 15-minute chart right here on the MACD. Well, we took a short position. What the heck did you just do that for? So we just took a short position up here at the top of this second drive. So we're going to see. Maybe that wasn't the right thing to do. Obviously, we're down 180 bucks. Whew. I bought some Bitcoin. I'm going to write an article in Pitt News Magazine for you guys about Bitcoin. I bought one Bitcoin. I've been in Bitcoin for years and years and years and years. I've told this story before. I got into Bitcoin. I actually was mining Bitcoin, where I got computers and I would mine the Bitcoin. If I still had those Bitcoins that I mined, I'd be rich, rich, rich beyond my wildest dreams. But I spent them, bought my son's tuition for his college degree. I oftentimes joke and say if I'd have not bought his college degree, he'd have enough money, he'd never have to work again. So, but I spent it. I made money and pulled it out and spent it. And that was, what I thought you did with money when you made money. But I didn't say hang on to it. But I've always been in and out of, I've made a lot of money in Bitcoin. I've done good with Bitcoin. I can't complain. And today I'm up $2,000, just broke $2,000 this morning on my Bitcoin. It's taken off like a rocket ship. And it kind of popped back the other day. So I bought one Bitcoin. One Bitcoin right now is $65,000. Is how much it costs to buy one Bitcoin. Now, of course, you don't have to buy one Bitcoin. You can buy it whenever increment you want. You can just go out and buy $10 worth of Bitcoin if you want to. But I bought one Bitcoin. I thought I want to own one Bitcoin. So I went and bought my one Bitcoin on that pullback. So my one Bitcoin today is up $2,000, 3.2%, and it's rocking. It's taken off. I think it was it what big bank was it? Like Goldman Sachs, or was it Charles Schwab? I can't remember. One of them put out a prediction that they believe that by the end of, I think, 2030, Bitcoin's going to be one Bitcoin is going to be worth $1 million. It's gone up significantly. I remember when Bitcoins were trading for $12. I think that's what they were for. When I first started mining them, they were like $12 for one Bitcoin. Now they're $65 or $65,000 for a Bitcoin. I think they were $12 when I started, something like that. Maybe I'm wrong. Maybe I'm remembering wrong. I can't remember. It was a long time ago. And they were just getting started. There's this new thing came out called Bitcoin. I think it was like $12 for one Bitcoin. Now they're $65,000 per Bitcoin, and they say they're going to go to $1 million. So I bought one Bitcoin. Well, this market just keeps going up, and we just keep losing, don't we? We're down $255. But how often does this market go up in the morning and then turn around and flush in the afternoon? You never know. You never know. So this is trading options. We could come over here, and the cool thing about options is you can say, well, I think it's going to go up now. Well, you can come in and buy another one. But look, we're coming in with the blue lights intercepting to the yellow lights. So let's draw our trend line. Since we're doing trend lines, let's come in here. And let's go text preferences. Show text. No, turn off text. Okay, so we got a trend line in here. Let's get rid of this trend line just because it's in the way. Clean things up a little bit. Let's get rid of this trend line because I already broke below that trend line. That was the trend line that gave us the trigger saying we should get in. This head and shoulders broke, but then it broke and came back up. So we have the downtrend like that. And that's where that thing broke. It started going back up again. It had another little counter trend right there. It's still going up. So draw our trend lines. Our progressive trend line is sitting right here right now. It's still going up. So let's get rid of these. Get rid of this one. So there's our progressive trend line. We're at the top of a fourth drive. I didn't think we'd get a fifth drive. Well, we got kind of this reset right here where the bars went red. And that's kind of like starting over with a new trend. That's the 15-minute chart. And there's the 2-hour chart. Oh, that's the 2-minute chart. 2-minute chart. We go to the 2-minute chart. We're like this. Where's our progressive trend line? So we go up on our progressive trend line. There we go. Kind of like that. And then our progressive trend line coming down the other way. Kind of like right in there. And then our progressive trend line this way. We're still going up. And land short with 2 options. The trend is your friend, land, till it bends or ends. Hey, I'm just showing you how things work. I'm just a tech support guy. And I bought some Bitcoin. I'm happy about that. Watch it flush tomorrow and go all the way back down, lose it all. I'm just going to hang on to Bitcoin until it's $1 million. Never going to sell my Bitcoin. I bought 1 Bitcoin. I'm going to never, ever, ever, ever sell it until it hits $1 million. Then I'll sell it. Take the full $1 million, and I don't care what it does after that. They said by 2030 it should be at $1 million. Does that mean you should go buy some Bitcoin? Heck no, not on my recommendation. Don't do anything I tell you to do. I'm always wrong. Look, I'm wrong on my options. I thought we'd break and start to fall back down. I just show you how stuff works. I'm just a tech support guy. I just show you how stuff works. You got to figure out how to make it work and make money. I've been able to make money over my career. But I'm no Ross Cameron. I can't trade like him. If you guys go over and watch Ross Cameron and you decide to start to trade like Ross Cameron and you make a lot of money, you better come back and tell me about it. You say, oh man, that Ross Cameron. Or if you go over there and trade like him and do what I did, which is lose $100,000. No, I didn't lose $100,000. Just joking. But lose all your money. Of course, I never did trade the way Ross Cameron does with real money because I couldn't make my demo account work the way he does it. He's a tough guy, that guy. He trades crazy. He's a wild man. Well, I'm disappointed, that our little call option example isn't working here. A little put option example. We're getting ready to break our trend line up in here, our yellow one. It broke our, where's this one at? Let's put right on that low point. Well, can't because it's already breaking it. We got to come up in here. Our trend line is getting pretty, where do you want it? I don't know, right there. Let's see what this bar does. I think we'll get a pullback in here. I think it's going to come up, break our trend line. I think it's going to come back down to test one of these longer term trend lines. This one here is set, way back there. There, touch there. Let's bring this one up to this touch here. We're still above that trend line. So technically speaking, you should still be long as it stays above that trend line. This was our Big long trend line here, right? This one, what have I got that one out there for? Oh, because that was that one way back there. I think this one here is better. Let's get rid of that one. This is our longer term trend line right here. You can see how many times it touched it. 1, 2, 3, 4, 5, 6, 7, and it touched it there from way down there. We could probably go back. There's the bottom. Let's go back here all the way to there. Now look at that trend line. Came in, ran across, right across there, right there, all the way across there, touched it there, all the way up, touched it again there. So that's a pretty well-respected trend line right there. This big one here, that is a well-respected trend line. Now I got this little trend line in here. Man alive, look at this market go. What an amazing market today. Holy cow. Those are all still green. Let's turn off the bulls and bears for a second. We got a little red counter trend in there. Get a little red one in there. So let's go from here up there. Then we got another little counter trend. Then we go green up to here. Do our progressive trend line like that. Wow, this market's crazy. Why didn't you buy right there, Lan, instead of sell? Oh, I thought it was going to go down. I thought we were going to get a pullback and a retracement against that last major trend. We had trend lines in here. We had trend lines in here. See, I thought we were going to get a bounce. I thought we were going to get a fall off here. That was a little head and shoulders formation. I thought it was going to come and go back down to the VWAP. Man, this thing's just going to the moon. Look at it go. As long as it stays above your trend line, you're supposed to stay in. That's the rule, right? And that's been our well-respected trend line on this range bar 6. Man alive, this thing is going straight up. What did Goolsby say? What did the Fed say? Come back here. Turn off that auto scale. I'll do it myself. I don't know. That's one crazy long trend. Look at that thing all the way from the bottom. First touch right there. If you'd have just taken this trend line, let's delete that one. If we'd have just taken this trend line and gone from the first touch to the second touch, which is right there, and then extended it, that thing stayed above that trend line the whole way up, just like that. We take the second one, go to the top, back down to the touch. There's the next touch. Touch there. Touch there. Well respected. Holy cow. See how that thing projected way out in the future off of just this little ABC pattern. So see, I don't trade no Elliott wave. I just trade these here ABC patterns. See that? So that first little ABC. Why not this one, Lan? Well, you could do that one too. There, there, there. Here, here, here. See how it goes through those little ABC patterns? I don't trade no Elliott wave. I just trade these here ABC patterns. Look at that. Just like a train on rails all the way up that thing. For those of you who are new and seeing me and missed the first part, an ABC pattern is an Elliott wave. That was the whole point. I don't trade these here Elliott waves. I just trade these here ABC patterns. ABC patterns are Elliott waves. It's just a name for ABC patterns. See that? Look at that. A, B, C, D. So we're right up at 61.8 right now. We're short the market. That's why we're sitting here watching this thing intently, because we think the market's going to come back down. I think it's going to come back down to that blue line. But right now, we're still above our trend lines, our primary trend line. This has got to be our primary right there, because that's the one that's most well respected. This is the secondary down here, because it was a little bit further back. It was well respected for the first couple, but then this one became more respected. So it's touching all the way along here. So this is the one that's kind of our, then you got the smaller ones inside, the fractal waves. Look, it's going to try and break up again. Oh my gosh, this market is unbelievable. Unbelievable. Bruce, what would have happened if we'd have put on a wild eye, crazy eye, iron butterfly? We'd be, I don't know. I think we'd be okay. Wild eye, crazy eye, iron butterfly makes money when the market runs really hard off of the long call and the long put. And we don't care as long as we stay in it until the expiration, we get our money. It's when you bail out early that you lose on the options when you do that, when you sell an option. Or when you buy an option. When you sell an option. When you sell an option, it starts to show a loss. You're going to get your $265 if you wait till the end, no matter what, on these. You're going to receive $265, but they might give you a position. We just want it to close below these red lines, right? Okay, they're starting to fall. Well, my Bitcoin's not backing off at all. Up $2,300 on my Bitcoin today. What about the overall market? 2,300. Let's see what else we got going here. I'm up 3,000, almost 3,600 total. Majority of that is Bitcoin. Okay, here comes the flush we were looking for. We're back down to 66. Now look, we're only losing $60. After all that, this, see, what would have happened? Let me back up here just a second. What would have happened if we'd have been trading with contracts and we thought was going to happen what happened here, where we thought the market was going to go down and we got in? We got stopped out probably a couple times here by now and probably be down a couple $100, right? If we were trading this and getting our hiney handed to us. We'd probably be down a couple $100. I don't know. I tried to get in twice, and both times I'd have got stopped out. Let's say I got stopped out. Both times. So we got in, let's say we tried to take a short position here and got stopped out. We'd have lost $100. Another $150. So let's say we'd have probably been down $200 by now if I'd have screwed up as bad as I did with the options. But because I have theta working in my favor, look, I'm only down $7.50 right now. And I never did get down. What was our worst drawdown? I think we were down once at $200, weren't we? But why did you sell them, Lan, and not buy them? Well, because if I buy them, then theta's working against me. If I buy an option, theta immediately starts to decay, and the market has to move in my favor fast enough to outperform theta decay and make a profit. If I sell it, then theta starts working in my favor, and the decay actually works for me. Now, it limits the amount of money I can make, because if you buy an option, you have unlimited profit potential. In this case, the max amount of money I can make is $262. But I'm happy with that. I got two of them. So max amount of money I can make is $500 if I just let them go all the way till the end of the contract. That's the end of the day, because there's 0 days till expiration. But in the meantime, because I'm not really planning on letting them go all the way till the end of the contract, I just wanted to see the market fall back down to the blue line. If it goes all the way back down to the VWAP, I'll take them off at whatever profit that level is at that point. But you can see I have 2 commissions I had to pay. I'm trading 50% of the value of one contract because the delta was 0.50 on the option. Theta is working in my favor this time instead of against me. So as time goes on and I was wrong, theta kept working in my favor, kept giving me money. That's why I like to trade like this with options. I like to sell options because it cuts my risk in half. And I got more staying power. So I was wrong, but now we're up $37. Got all my money back. But I wasn't that wrong. I was just wrong by one trend, it looks like. I don't know. We'll see. It might turn around, come down, touch that trend line. See, it blew right past that trend line. So that's our exit point on the overall longer term trend line, because that thing just blew past our trend line. There it is right there. So if we take our progressive trend line up along there, we got the first, probably right there. That's the trend line where the first, because if you go progressive, see, you start at the very first one, and you don't want to make decisions based on just 1 or 2 bars. You want to wait till the market moves farther in your favor. So each progressive, it jumps to the bottom of the next one, and then I get a full open, high, low, close bar underneath the line that's red like that right here. So you come to the red one. Did that full red close? Yeah, it did. You go one more. Then you get it corresponding with and there you go. There's your confirmation of the trend line, mathematical trend line. That's where you get out. It's easier in hindsight, right? But that's the idea. Learn from the past to trade in the future. But that's a progressive trend line. You see how I moved it with every bar. And that's why I like to use the ATR, because you can kind of correspond them. And what you generally see me do is come in, and I don't do the progressive trade. We just come in here and we say, well, there's an arrow here, an arrow there, green trend, and just there's our trend line. There we go. Then we just draw the trend line in there. Say, okay, there's our break. Let's go. And I say there's one up for every down. I draw my trend lines in. So trend lines are one of your most powerful things, but that's why ATR, that's why I love the ATR, because it helps you draw your trend lines. Where are we at? All right. We're up $2.50 and the market's starting to rally. Look, it bounced right off of that. Look at that. That trend line. You're like, that trend line was set so far back. Why is it respecting that? Isn't that cool? Look at this. Right here. We set that trend line off the first ABC pattern right here. The first one, ABCD. And the market, then we went to the next one, which brought it up to here, and it started to respect that one. We had this one in here, like that. See, we had that little one inside there, and then it broke here. If you went with your progressive trend line, go off of this one, and then every time it comes up in here, up in there, but then it started to cut them off. So I'd say probably like right there. So we got kind of a nice little move right up in there, and then it rallied hard and then broke right there. Came down to that one, that one, that one. That's your little light show. But these longer term trend lines, remember what we were talking about, the longer term trends. We're down here on range bar 6, range bar 2. I mean, just look, now we're getting another break. Do the progressive. We'll put this on here because we're doing progressives today. So we'll put that right on the top of the first red, right there. How's that? Then we'll put this in here. Oh, that's the first green. So we're going to go to the first green. So let's see if it breaks above the first green on the 2-minute chart. It should just be a little counter trend, right? Should just be a little counter trend up in here. And then it should turn and flush one more time. All the way back down to the blue light and this red trend here. No, that's a counter trend. So let's get rid of this one. We don't have a downtrend yet, do we? We could say across these two. That's probably where we're looking. Let's see what it does. It's coming into a little triangle formation here. See if it'll break out the bottom. We're up $7.50 on our options. Lynn, I want to make more money. You are not making enough money. I'm going to go watch Ross Cameron because he makes $100,000 a day. Okay, go do that. He's also trading $1 million account. But you got to start somewhere. Everybody got to start somewhere. Oh, man. Bitcoin just keeps going straight up. Somebody gave it some Viagra. Oh, it's making a little flag formation. Okay, here we got our little break, our little two counter trend, 2 bars. This is pretty common, right? We see that all the time. Four nice big, there's 5. 1, 2, 3, 4, 5 red bars. We got a little counter trend, and then we start back down again. If we were trading with contracts, we'd be looking to take a short position right here. But we're already short. We got our short option, so we'll just stick with it. You could put on another option right now if you wanted. If you did, though, you'd have to come up here and sell another one so that you didn't have a margin go and get a margin call. Okay, just sold another one. So now we're in with 3. Three calls, 3 sold calls. So these are just spreads is all it is. It's like the upper wing of a iron butterfly or iron condor, right? It's a vertical spread is all that is. Just selling just putting on vertical spreads. So we're up $250 now. That's what it says right there. Down here. Let's see. Chart. Let's raise our. There we go. All right. So we got 2. So we're up $285 on these, $265 and $50 on that one. So we're up $312 right now. And where did our long-term option? Where did our long-term? Oh, we're on the 2-minute chart. Let's go back over to our range bar 6 chart. Okay, there's all of our long-term views. Okay, so we got our little counter trend. Remember we said right here, we got our little drop, and then we got 2, actually we got 3 green bars over here, and we said we'd take another short position. We're looking for it to come back to the magic blue line. And sometimes we'll get we might get another little set of green dots here, right? Little bars, little green bars, and then the next one down. We might not get the next one down because in an Elliott wave, the ABC pattern comes off the top like this. I don't trade no damn Elliott wave. I just trade these here ABC patterns. These here ABC patterns are Elliott waves. Okay, so we just all want to be on the same, use the same terminology, just so we all know what we're talking about. That's all. It's called a community. We speak the same language. Okay, let's see if it happens. Let's draw our trend line, should we? Let's get rid of this. Okay, let's come in here. Let's turn off the text. And let's draw our trend line. Let's get rid of, these are all worthless now. Well, actually, this one could still be in play. Let's get rid of all these. These back here don't need to be here. Just clean things up a little. Let's get rid of this one. 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 We don't need that one. I'm just going to keep these two because they can become resistance because the market can come back up and bounce off of them this way too. Or that would be ugly if it did that on us. But that's what happens. That's resistance becomes support, support becomes resistance. So now we're going to draw our trend line from here to here. Now, as long as it stays below that trend line, we stay in, right? So we got A, B, C. And then as long as it stays below that trend line, we stay in. Now we can draw a more progressive trend line. We can go from here to here. But we're going to stay with the longer term trend. So as long as it stays below that trend line off that A, B, C pattern, we're going to stay in. Looking for the market to fall, fall, fall. Now, remember, you get an Elliott wave. It's generally 3 drives up and 2 drives down. This market had just an unbelievable run this morning. So we go off one of these lows down here, Fibonacci. But that's not even the low because we know it goes down one more. Market has a tendency to come down half or 50% of the last major move. Let's go to our 2-minute. We'll go from top to bottom. So we go from bottom all the way to the top. And then we know that the empirical, look at that. It's coming right back down into the Fibonacci sweet spot, just like a train on rails. There it is. What do you mean the empirical sweet spot, Lan? This is something that we talk about, isn't it? And if you were in my class last night at the university or Friday night, we talked about the empirical data distribution, which is something we talk about in here all the time, because it's the most important thing. I thought you said that other thing was the most important thing. They're all the most important thing. Why can't I find it? There it is. There it is, right there. There it is. Calculating the delta Kona probability. Approximately 68.2% of the time, market stays within 1 standard deviation. If it leaves the 1 standard deviation, it likes to come back to the 1 standard deviation. So if it goes up into the 2 standard deviations or the 3 standard deviations, it wants to return and come back to the 1 standard deviation. Nearly 97% of the time, it falls within 3 standard deviations. But when it does that, that's the retracement. That's why Fibonacci works. That's why Bollinger Bands works. That's why the RAF indicator works. That's why all those tools were created, because tools analyzing means revision. Fibonacci ruler measures retracements and extension levels to identify mean revision points. Bollinger Bands visualize volatility and potential reversion zones around the mean. RAF channel detection linear trends and highlights deviations of potential reversals. Okay, that's what that whole thing is all about. Entry points. Traders look for deviations from the mean. 1 standard deviation to 2 standard deviations is potential entry points for mean reversion trades. Risk management, understanding revision zones helps to setting stop losses and profit targets. Option traders use mean revision to write calls and or puts at the center of their 1 standard deviation range, which is the VWAP, taking advantage of statistical advantages that prices stays within this range approximately 68.2% of the time. So that's what we're doing here. We're trading the mean revision. So if a market rallies all the way to the top, this is considered the delta cone of probability, right? So let's call wherever that VWAP is the delta cone of probability. That's where it gets calculated at. Now we're starting from the low here all the way to the top, which means that this becomes the delta cone of probability right there. So let's get rid of this and I'll draw it again. So the delta cone of probability from the top of the trend to the bottom of the trend means that the delta cone 61.8% of the time is going to want to come back into that delta cone of probability that you just saw that picture, right there. That's what I just drew. I know mine is prettier than this one. This one is not nearly as pretty as the one I drew. See how pretty mine is? But that's what that is. That's why that 50% is there. That's why that 38.2 is there. That's why that 61.8 is there. That's why that high is there. That's why that low is there. Markets have a tendency to go up and then turn around and come back into that cone of probability. That's why we use Fibonacci rulers. Once the market does that, it'll have a tendency to go to the next one. This is what we call I forgot what the name of it is. Darvas box is right on the tip of my tongue. So then the next one is up here. Where's my Fibonacci ruler? So then we go from this peak up, and we don't know how big it's going to go, so we're just going to guess that it's going to be the same distance as the last one. So from here to here, that was 123 ticks, right? So we're going to go 123 ticks, and we're going to draw the next one up there. That's called a Fibonacci projection. And we're going to say if the market does the Fibonacci thing and stays within these cones of probability, it's going to go up and do this. Called a trend, right? Hey, I don't trade these here A, B, C, D patterns, Elliott waves. I just trade these here A, B, C patterns. So this one, actually, this Fibonacci projection says that I've got it kind of a little aggressive, thinking it's going to come all the way up here. It's going to probably be out in here. And who knows if it'll do it in one day or if it has to take multiple days. But this is the idea. You're going from one Darvas box, which is this box here, to the next Darvas box, which is this box here, through the Fibonacci cone of probability, from low to high, back to the delta cone of probability, and then we go up to the next one and then back to the delta cone of probability. And that's where you get your longer term ABC. So ABC, ABC, ABCD, projection back. See how it all works? It all works out just like that. We're coming back. We're up $235. Let's come in and look at our shorter term time frame. What do we think this market's going to do? Well, it's not respecting that trend line. It broke above it. So we could take some profits. So what we're going to do is we're going to come in here and we're just going to say on the options, we're going to go exit chart options. Yes. Out. Rejected our break-in order. Which one didn't it like? This one. Preferences, send it back, liquidate the option. See if it'll just do it like this. Okay, we're out. Done. So there we go. On our Wild Eye, Crazy Eye, Iron Butterfly, we made a couple $100 on our little options trade here that we caught off the top. A little early, but we caught it anyway. We ended up with a couple $100. All right, guys, that's it. That was my lesson for today. Progressive trend lines. Count, measure, setup, trigger, and follow through. Got a Sunday school lesson for you. Let's come in and see our Sunday school lesson. Be unique. 90% of traders lose money. All right. 90% of traders lose money. Most traders buy high and sell low. That's the wrong thing to do. Don't buy high and sell low. Only trade the extremes. Buy low, sell high. Don't trade basing sideways markets. Now, don't trade basing sideways markets. You can do that if you're going to sell some options premium, right? We like to do that. If you're going to sell some options premium, just to collect the premium off the options as the market goes sideways, you can trade sideways markets. Remember, markets can only do three things, right? They can go up, they can go down, and they can go sideways. So we got that little slide here for you too, because none of you have ever seen that one. Come on, faster, faster. Right there. Markets can only do three things. They can go up, they can go down, and they can go sideways. So if the market's going up, buy contracts, futures, buy shares, stocks, buy call options, sell put options. That's how you make money if the market's going to go up. Market's going to go down, you're going to sell or short contracts and futures, sell shorts, shares in stocks, or buy put options or sell call options. That's how you make money when the market goes down. And that's what we did today. We sold call options right there. Okay, that's how we made money today. We sold call options. If the market goes sideways, this is how you make money. You sell call options, or you sell put options, or you sell both. And that's how we made money on Friday, right? And that's why we started with a couple $100 profit today. It's because we sold call option and we sold put options on Friday. We actually made about $1,500 on Friday because we sold those options. And then we had the long call and the long put, which still made even $150 today. So, and if we'd have held on to that thing because the market went to the moon, we'd have made a lot more. Probably think about that. We liquidated those so that we could do this other strategy. But had we held on to those all the way to the end of today's day, that'd have been a nice trade. Made a lot of money. All right, so that is the name of the game. It's still going up. Look at that thing go. It broke that trend line, and that's your buy signal saying we're going up again. I don't know if I want to do it, though. It's got too much resistance up here, and the market's really run. I don't know. That's a crazy market today. Let me look at my Bitcoin before we go. It's come down a little bit. I'm only up $2,000 on my Bitcoin today. But doesn't matter. It's irrelevant because I'm not selling it. I'm not going to take the profit and run away and go buy things with it. I'm going to hang on to it till my Bitcoin hits $1 million or I die, whichever comes first. Okay. They said it was going to go to $1 million. Hey, I believe them. We'll see. I had some Bitcoin at $12 and now it's $65,000. So who knows? All right, guys, we will see you tomorrow. Tomorrow is going to be power hour. So tomorrow afternoon, tonight, we have class at the university. So those of you who are university students, we'll see you in class tonight. Be there, be square, right? Exactly 6 o'clock. We're going to begin. And it's our last night of our advanced technical analysis class. And we're going to continue the discussion that we had on Friday, talking about accumulation distribution. All right, guys. Great to have you. Glad you made it. And we will see you tomorrow. Tomorrow's power hour, so it's going to be 12 o'clock noon, right? 11:55 tomorrow afternoon for those of you on YouTube. See you then.